Hello and welcome to BQ Prime. We are at Morgan Stanley's India Investment Forum. It's an opportune time for Morgan Stanley to host its annual conference here in India, especially when there is a wave of optimism about India's economic story. And who better to speak than Chetan Ahya? Welcome, Chetan Ahya, to BQ Prime. He is Chief Economist Asia for Morgan Stanley. What brings you to India?
So we have this annual investor summit. We call this as India Investment Forum. So that's something that we've been doing for a number of years. But during the pandemic, there was a gap, and this is the first year after pandemic that we are again kickstarting this process of gathering investors on an annual basis. Yeah.
So, as I said, there is a great deal of optimism about the India growth story. We just had a pleasant surprise for the fourth quarter number at 6.1%, and we are looking at 7.2, and many people have upgraded. What are your initial thoughts on the India growth story in terms of the GDP numbers?
So we think India is on track to achieve closer to 6.5% GDP growth when you take it as an average of 2023 and 2024. And that is pretty much in line with our constructive view. So yes, there was an upside surprise, but the broad narrative that we had that India is right now at a point where it is having tailwinds from both the cyclical as well as the structural factors. I think that's what really is behind that story of growth surprise.
But we are still not yet gone back to the pre-pandemic level. That's some time away, I guess.
We are above pre-pandemic level, but if you kind of draw a pre-pandemic path, which is taking the rate of growth which we were doing before pandemic, take the starting point of GDP, let's say index to 100 in December 19, and then apply that growth rate, then we are still a bit below that. But we're definitely above the pre-COVID levels. So we're well above that pre-COVID levels.
So India perhaps is the only country which is about the pre-pandemic level. Are there
No,
other
the other
countries?
countries are also back up. I mean, US particularly has done extremely well. But yeah, India is one of the stronger growth economies that we are seeing globally after pandemic.
Yesterday, the World Bank flagged two issues. They said they marginally reduced the forecast, and two problems that they pointed out. One is consumption because of inflation and rate hike. What do you think? Do you think they will be hurdle to the growth in the near term?
Well, not really. I don't think interest rates have been a hurdle. So you can see how car sales have been improving. Now we are hearing the two-wheeler companies also saying that they are seeing some strength in the demand going forward. And we are seeing that real interest rates in India are not that high that will constrain the domestic demand. And as far as inflation is concerned, it was an issue. But as inflation has come down, we think real disposable incomes are actually now improving. And therefore, you should see that consumption recovery will also broaden out. So far, consumption recovery has been more in services than goods. It has also been stronger from middle to high income versus low to middle income. But going forward, we think that consumption growth will broaden out from services to goods, and even the lower and middle income segment will start spending. And there is early signs on that front. So I mentioned to you about the two-wheeler sales story. And if you listen to the commentary from the staples companies and other consumer sector companies, they are saying that they are seeing early signs of rural demand improving. So we think we are just at that cusp where the overall recovery on the consumption front will broaden out.
Unless, of course, monsoon plays a truant, I suppose.
That's right. That's a risk, but I think that is a bigger risk to inflation rather than growth immediately. But if inflation does go up, it will eventually mean tighter monetary policy and therefore additional downside to domestic
Right.
demand.
So the consumption that's been happening over the last 6 months or 1 year has been primarily because of the government push. Government has been giving a heavy lift. So do you think that government needs to do that kind of heavy lifting this year as well?
Well, actually, as far as consumption growth is concerned, government has not done much. I mean, that's a story across Asia. It's not like US and Europe where government gave the fiscal transfers to the households. So consumption growth in region and in India, the way it's picking up is with normalization of the labor market. So as the economy reopened, and services sector activity was unconstrained, you began to see job growth back in those sectors. And that's then driving income growth and consumption growth, which is the main driver. And we think that as recovery broadens out, you will see more of that benefit from income side reflected in consumption growth in India.
So, which means that managing the fiscal deficit would be much easier now than what it was, let's say, last year or the previous year.
Absolutely. And so, yeah, you've seen that, the economic recovery from fiscal deficit perspective is reflected in that strong GST revenues. And the government has, at least so far, even in this year's budget, kept a lid on revenue expenditure and total expenditure. So we are, as of now, from the government policy actions, feeling that we should be able to achieve 5.9% fiscal deficit and not have to worry about any increase in fiscal deficit.
And that's also partly because the RBI gave a surplus bonanza to them, which may not be available in the coming year, I suppose.
That's a small
Small
factor. I
factor, yeah.
think the bigger reason is that the tax revenues have picked up, and since the economy is doing well, the government is under less pressure to take up any other additional fiscal expenditure.
Okay, so for staying put with the consumption part, do you think RBI will cut rates, let's say 2 or 3 quarters down the line, and it should be able to push up consumption as well?
So I don't think we need rate cuts to drive
Right,
consumption,
yeah.
but we are expecting the RBI to cut rates in first quarter of next year, so quarter ending March 24. We think that there is a possibility they could cut rates in fourth quarter of this year, but that will depend on the way inflation evolves and also what happens to the Fed policy.
So the next important question I have in mind is, where do we go from here? In if I look at different parts, manufacturing has not been a very bright spot. Agriculture is showing some signs. Services have been very good. Exports have not been very good for reasons because of the global situation. Manufacturing in particular has not been very good. What are your thoughts on manufacturing?
Well, the recent GDP data shows that manufacturing sector has also picked up.
Yeah, in the fourth quarter, yeah.
I think the IIP tends to understate. So if you're looking at IIP, yeah, you will be concerned about the manufacturing sector. But I think it's better to look at the GDP component. IIP is on an old fixed weights for various sectors, and one particular sector which is like mobile phones and the consumer durables. The weighting on that is still based on 2011-12 index year. So I think there is a bit of a disconnect between the IIP data and what is happening underlying in the manufacturing sector. So the manufacturing sector is definitely impacted by the weaker external demand, but because of the strength in domestic demand, manufacturing sector is doing quite well. And I think two of the most important sectors that I would look at for manufacturing sector health is the growth rate for steel and cement. Those are the bellwether industries as far as the manufacturing sector is concerned, and they are doing extremely well.
Construction is doing very well, of course.
Exactly.
Um, in terms of risks, you know, the two most significant ones have been the crude oil prices in the past, which is kind of flattened and it's not top of mind worry, I suppose, and the fear of global recession. What's your assessment of these two risks going forward?
So as far as oil is concerned, we are kind of in a neutral camp. We don't expect a big rise in oil prices, neither do we expect a big fall. Um, we think that to the extent to which global growth is going to remain well below trend, there is that constraint on oil demand, and at the same time supply part is also looking okay as of now. And so yeah, I think oil is definitely not the immediate concern in our mind. But as far as the US recession risk is concerned, it is pretty much there as a risk that we are considering. The way I would put it is that if you get a slowdown in the US economy or even a mild technical recession, that would be soft landing. But if you get a deeper recession in the US, let's say 1 to 1.5% full year GDP growth contraction, that would be decidedly negative. So I think I would differentiate between a mild technical recession and a deeper recession. So if it's a mild technical recession or just a deeper slowdown, then I think India and Asia should be fine. But in a case where there is a deeper recession, there will at least be for a temporary period, kind of call it recoupling,
Right. Yeah.
and challenges for India's growth
So,
story.
but deeper recession is not in sight now, or is it some time
It's
away? If
it's
it
it's not in our base case, and we think that the risk of that is relatively low, and that's for two reasons. We think the U.S. macro situation is different in this cycle. Number one is both corporate and household balance sheets are in a pretty good shape. And number two is that the labor market is also in a state where there had been existing labor shortages, versus a typical recession scenario where before recession, corporate sector would have overhired workers. So you get an exacerbation of a downturn into a deeper recession when the corporate sector is over leveraged and it defaults. And if it is overhired at the same time, it will fire a lot
fire
of
on
people.
people?
So it exacerbates the downturn and gets us into the deeper recession scenario. But in this cycle, because of these two factors being different, we are somewhat confident that this would not lead to a deeper recession in the US.
Okay, so which means my next question is, which is a bigger worry, the US or China?
I would say that right now, in the next 6 months, it's probably China. But beyond 6 months, it would be US. We are expecting China to take policy easing measures, so it should recover. But in the near term, before the policy actions are actually being put in place, there will be a question mark as to how much is the deterioration in China's growth rates.
Okay, there's been a lot of noise and headlines saying that manufacturing can shift from China to India. How true is it? What are the ground realities? Is it really something that can be achieved?
So I think right now the evidence suggests that what happened in the last, I would say, 3 years, since pandemic concerns unfolded, China's market share in global goods exports increased. India's market share in global goods exports also increased, but relatively smaller magnitude. So the way it's evolving is that the all of Asian economies are able to increase market share,
Yeah.
including China. So as of now, there is not much evidence of India taking away China's market share. Going forward, there are certain sectors in which it could happen, but the way it is going to happen, in our view, is that China outsourcing will not grow as fast, whereas it will grow faster in India. So that will be a passive way in which India's market share will increase. We don't think it is going to be easy for multinationals to uproot plants away from China and put it into India. So it's more like a passive increase in market share that we envisage for India.
So, leaving China out, if I look at other Asian countries and Japan, of course, if I leave Japan and China out, uh, where does India stand in terms of its competitive strength? Let's say comparing with Bangladesh or Vietnam, because everybody is trying to be more competitive and capture a lot. So, where do we stand in terms of competitive strength, especially given the challenges of managing currency?
So I think when you are thinking about India's competitiveness in global comparison, you have to take goods and services taken together. The strength that India has in services is the best in emerging markets world. Um, yeah, so when you look at India's market share in global services, it's 4.6%. That's the highest. It's the DMs like US, UK, who have which are the other countries which have high market share in global services exports. So, so services is like India is numero uno in that sense in emerging market world. As far as goods is concerned, India had been lagging, but now at the margin, we think India is going to be the one which will see, compared to the countries that you mentioned, India will probably see the maximum increase in market share in global goods exports.
Over the last 2 to 3 decades, I would look at three buckets, which have made a big transformation for India, starting with information technology, telecom, and Aadhaar. All three put together have changed the way we do businesses, brought in a lot of inclusion among the populace. That itself is a big shift. What, in your view, is the next big shift that India needs to focus on?
So it is essentially, I would say, 2 points. Number one is that the shift in government's policy focus away from redistribution to increasing capital expenditure and focus on job creation is the most important shift that India is implementing right now over the last 5 years, and that is what needs to still continue. Um, I know that we have elections in
Yeah.
2024. Whatever is whichever is the political party in power, as long as you have, hopefully a majority government, but even if it is not a majority government, as long as the economic policies are oriented towards this mix, that will be very critical for India's growth rates to sustain at that 6.5% that we are saying we'll be able to achieve in 23, 24. And I think number two is within that focus towards investment and job creation, it's the infrastructure spending that needs to continue. It's a challenging task. We've seen in the past, in our own history, to be able to map out and implement infrastructure spending and creating capacity in the infrastructure across the board in a organized manner. Because you could have, let's say, a highway built, but then you need to have the last mile
Correct.
linkages and things like that. So the Gati Shakti program is precisely aiming to do that, but that needs constant effort, because this is now you are spending more and more on a higher GDP size. It is that much more challenging. But I think that's something that will be critical to ensure that India growth story continues to unfold.
What's your view on renewable energy? I think that's going to be something very important. Are we paying much attention, or is there much more that we can do so that in the next 5 years we can say that, look, 20% of my energy requirements comes from renewables, be it solar, wind, or EV vehicles? How do you read that transformation?
I think India is doing well, and I think it's not just the government policies, but also that the global um, marketplace has made that big shift, and there is enough support coming in from the foreign investment side and the global investment community. So both together are enabling India to make that transition, and I think we are on the right track.
What's been the mood at the conference? Bullish, very bullish?
I would say bullish. People are very constructive, or I would say they're very bullish on the economy. But from investors' perspective, what we hear is that they are also finding the valuations in India for the stock market a bit more expensive than the other emerging markets. So they are bullish, uh, but they're not really, putting in the next dollar in a rushed manner, because the valuations are somewhat of a concern for them.
Okay, so bullish on economy, valuations high for the market. Wonderful talking to you, Chit. Thank you so much for
Thank you
joining
very
me.
much.